So in this video I'll take you through the latest DCF model for Intel. I've made some changes to the assumptions following the recent Q1 earnings release and changes in management guidance, so I thought I'd share with you the results. First of all, I'll take you through the assumptions that are used in the model. We'll take you through the base case forecast, then we'll jump into the model, I'll take you through the DCF, and then we'll have a look at the IRR. And then after that I'll just take you through some of the scenarios. So there's also a bear case scenario and a bull case scenario. I'll take you quickly through them, and then to finish off I'll just show you a one page with the three different scenarios in so you can see the difference between them. Okay, let's get started. Okay, so looking at the assumptions then, we've got a tax rate of 12%, a discount rate of 7.9%. For the discount rate we're using the WACC, the weighted average cost of capital. This is slightly up versus the last time I did this due to an increase in cost of debt. Perpetual growth rate is 2%, EV to EBITDA multiple 6.5. I've also lowered this slightly just to be on the safe side. Transaction date 13th of June. Fiscal year end for Intel is 25th of the 12th. Current share price at the time of doing this analysis is just over $39 and shares outstanding just over 4 billion. The debt and the cash, I've used the latest results figures, so we've got just over 37 billion for debt and 38.5 billion for cash. The other changes I've made in this DCF since the last time I did this was I've increased the capex in the model. Intel are spending a lot on capex, so I've just slightly upped this. The revenue growth forecast then, so for this year we've got a decline of 4%. This then goes back into growth for next year at 3%, then 7%, 7% and 8%. And then this transfers through to unlevered free cash flow at 2 billion for this year. Then that increases over the years to 11.6 billion in 2026. Moving to the DCF then, we've got the unlevered free cash flow, which we've already just gone through. You can see that this is slightly adjusted due to we've been halfway through this year, so the cash flows are adjusted for that. For the terminal value, we've used the EV to EBITDA multiple and the growth exit, taking an average of these. The terminal value and then the adjusted unlevered free cash flow, we then get the total adjusted unlevered free cash flow. Looking at the net present value, we've got a total net present value of just over 200 billion. We add cash, take away debt, and then we've got the equity value, which is just over, well, 202 billion, with cash and debt almost cancelling each other out there. Divide that then by the shares outstanding and we'll get the equity value per share of just over $49. If we look at that versus the market, then we've got a current market value at the time of doing this, just over $39. Intrinsic value is just over $49, so we've got an upside of just over $10 or 26%. Now we'll look at the internal rate return, or the IRR. First of all, we need the enterprise value, so we've got the market cap there. This time we add debt, take away cash, and we've got an enterprise value of 158 billion, or it's almost 159 billion. We can then take this enterprise value and use it as our investment amount. So you can see that there, that's brought in. We'll bring across the unlevered free cash flow from the previous example. This then gives us our IRR calculation, which works out at 13.7%. Now at the bottom here, what I've done is I've done some scenario analysis, so we can see here that looking at the current stock price, which is just over $39, we've got the IRR of 13.7%. If the stock price was to increase 20%, then the IRR would reduce to 9%. If the stock price reduced 20% to just over $31, then the IRR would work out at 19.8%. There I've just taken you through the base case scenario. We'll just have a quick look at what the bear case and the bull case scenario looks like now. For the revenue growth forecast then, we can see we've got a decline of 6% for this year, decline of 3% for next year, flat in 2024. Growth then picks back up at 6% and 8%. This filters through to unlevered free cash flow, giving us 1.8 billion for this year. There's a good jump next year in 2023, and then there's a decline again in 24. The decline is basically the way that the model is working out the change in net working capital. This then increases to 9.2 billion in 2026. That gives us an intrinsic value of $40.60, which is an upside of 3.6%. For the IRR, then we've got IRR of 8.6%, and again I've done some sensitivity around this. If the stock price increases 20%, IRR drops to 4.1%. If the stock price drops 20% to just over $31, we've got an IRR of 14.5%. For the bull case then, we've got revenue growth forecast still got a decline this year at 4%. Next year then growth picks back up at 3%, this rises to 7%, 13% and then down to 11% in 26. This filters through to the unleveraged free cash flow and it gives us 2.1 billion for this year. That then increases up to just over 13 billion for 2026. For an intrinsic value then we've got $53.88, that's an upside of 37.5%. And then the IRR for that is 16%. Again, sensitivity analysis, if the price increases 20%, the IRR drops to 11.2%, and if the stock price drops 20% to just over $31, the IRR is 22.2%. To summarise then, we've got the base case scenario which gives us a potential upside of 26% and an IRR of 13.7%. If things don't turn out as planned, it might be leaning more towards the bear case scenario. This gives us still a potential upside of 3.6% but an IRR of 8.6%. If things work out better, slightly leaning towards the bull case scenario, that gives us a potential upside of 37.5% and an IRR of 16%. I hope you found that interesting. It'd be great if you could give us a thumbs up and subscribe as we try to grow this channel. Also, don't forget to visit us at the website for some more detailed analysis. Thank you.